Welcome to the Deep Dive. Today we're really tearing into SoFi Technologies, ticker SOF.
Right.
This is that digital financial disruptor that's done something, well, pretty much unheard of, right? Successfully pivoting from just a niche lender into this full-service banking ecosystem.
Yeah, the sources we've looked at share just relentless momentum. But, and this is the big but, the market seems to have priced in like near perfection already.
That's exactly the tension, isn't it? We're looking at a company that's, executing brilliantly. But you have to ask, at what point do the risks, especially in that valuation, start to outweigh the potential rewards?
And the market's putting a number on that right now. SOI is trading at 26.895 a share. That's our starting point.
26.895 cents. Okay. So we've run the numbers through our educational discounted cash flow model to try and estimate its intrinsic value range. We'll share that range in our conclusion.
And the challenge, I think, is clear. That stock price implies almost flawless execution from here on out.
Right.
So we really need to dig deep into those fundamentals, see if the engine can actually deliver on that promise.
Absolutely. Let's jump right in. Let's start with the foundation, the architecture that powers this whole thing. Chapter 1, business understanding.
Okay.
So at its heart, SoFi isn't like just another bank. It's this ecosystem built on an idea they call the financial services productivity loop, or FSPL. Sounds a bit like corporate speak to me, but what does that model actually do in practice?
It's basically the engine driving that growth hype we mentioned.
Yeah.
Think of the FSPL model as a strategic funnel. They pull in a customer who they insist on calling a member, often with a really competitive product, maybe even a loss leader sometimes, like a low-rate personal loan, or maybe one of those high-yield savings accounts you see advertised.
Okay, get them in the door.
Exactly. And once that member is in, the whole game is to just relentlessly cross-sell, offer them higher margin products across the entire SoFi platform. The goal is to dramatically boost that member's lifetime value to the company.
Right, so that's the loop. How's the company actually structured then to keep that loop going? I see three main segments bringing in revenue.
Yeah, and those three segments really show how they've managed to diversify away from just being, a loan shop. First, you've still got lending. That's the original engine. Personal loans, student loans, home loans. That's where they started.
Still the biggest piece?
Historically, yes, but here's where it gets really interesting. Second, you have the technology platform. Think of this as their B2B play. They've even called it the AWS of Fintech.
Okay.
This is powered by their big acquisitions, Galileo for payment processing, and Technices for the core banking platform technology. Now, this part is critical because it generates recurring, high-margin, fee-based revenue. It's not as dependent on the ups and downs of interest rates.
Got it. And the third piece?
That's the financial services segment. This is the consumer-facing digital bank stuff, SoFi Checking and Savings, SoFi Invest, the SoFi credit card, all those direct-to-consumer products.
So looking at the mix now,
yeah, the really key insight here is how successful that pivot has been. Those technology and financial services segments, the newer ones, now actually account for 55% of total revenue. That's huge. It provides a major counterbalance to the risks in the more cyclical, capital-heavy lending business.
okay, that sounds like smart diversification.
Yeah.
But, the financial world is incredibly crowded. You've got established giants, scrappy fintechs. What are SoFi's actual competitive advantages? Their moats, so to speak. What stops Chase or Bank of America just crushing them?
Good question. I'd point to four main moats, but two are really structural game changers. First, there's the obvious one, brand strength. They've spent massively on things like the SoFi Stadium, NFL partnerships, very high visibility.
Can't miss it.
Right. But the second one, and arguably the most powerful weapon they have, is the national bank charter they secured back in 2022.
Okay, I think this is probably the crux of it for the market, right?
Yeah.
Why does having that charter fundamentally change the whole economic picture for them?
It boils down to cost of capital. It's huge. Before they got the charter, SoFi had to fund the loans they made using, expensive warehouse lines from other banks or by selling off loans through securitization. Both cost a lot.
Right.
With the charter, they can now fund those exact same loans using low-cost deposits from their own members' people using SoFi Checking and Savings. Our sources estimate this shift saves SoFi something like $515 million a year in interest expense.
Wow, $500 million.
$500 million they're not paying to Wall Street anymore. They can plow that back into better pricing, more marketing, developing new products. It's a massive, enduring structural cost advantage that other fintechs without a charter just can't match.
Okay, that's a powerful one. What else?
Third advantage, and this ties into that tech platform segment, is their vertically integrated tech stack. Because they bought and now own Galileo and Technisys, they're not paying licensing fees to potential competitors for their core technology.
So they control their own tech destiny, basically.
Precisely. And it means they can innovate faster, roll out new features, new products, much quicker than banks relying on older third-party systems. We're already seeing payoffs like their internal AI chatbot, Connecta, apparently improved customer service response times by like 65%.
Impressive.
And the fourth moat is simply scale. They've proven the model can attract users. We're talking 11.7 million members now, 17.1 million total products, and that member base is still growing incredibly fast, like 34% year over year. That scale gives them data advantages and operating leverage. Now, moving beyond the business mechanics, let's talk about the driver behind the wheel, CEO Anthony Nadeau.
Chapter 2. Management evaluation.
Yeah, Noda's background is pretty unique, and I think it gives a lot of institutional investors comfort. He's got this fascinating blend of hardcore finance and high-growth tech experience. Started at West Point Army Ranger, then became a top-ranked internet analyst at Goldman Sachs.
Right, I remember him from his analyst days.
Then he was CFO of the NFL, and after that, both COO and CFO at Twitter during a really high-growth period.
That is quite a resume. It's not just a finance guy or just a tech founder. It's someone who seems to understand scaling, complex operations, and financial discipline. What's his track record specifically been like at SoFi?
Well, since he took the helm in 2018, he's overseen that incredible member growth from around 430,000 to over 11.7 million now. He was the one who successfully navigated getting that crucial bank charter. And maybe most importantly for investors lately, he's steered the company to actual JAP profitability.
Okay.
His playbook seems clear. Professionalize a promising tech disruptor and build it for the long haul, build that durable moat.
I mean, looking at how he's allocating capital, it seems totally focused on building that moat, right? Mostly through those big acquisitions, Galileo, Technisys, which was a $1.1 billion all-stock deal. It's all about reinvesting back into the business. No share buybacks, no dividends.
Correct. The focus is laser sharp on maximizing that FSPL engine, that flywheel effect. However, there's a number we need to look at critically when we talk about all this investment.
Right.
The return on invested capital, or ROIC. Our calculations put it relatively low, somewhere around 3.76%.
Okay, 3.76%. That number might, raise a few eyebrows for investors used to more mature, efficient companies. If the return on all that capital they're pouring in is that low, is that a red flag? Are they maybe burning cash too fast, just chasing growth?
It's a really important question to ask, but I think you have to view that 3.76% ROIC through the right lens. This is a company that just became profitable on a GAAP basis.
Right, 7 quarters now.
Exactly. So they're still very much in the phase of consuming capital to build those long-term structural advantages, the bank charter integration, the tech stack build-out. These are investments designed to pay off over the next 5-10 years.
So it's an investment phase number, not necessarily an efficiency problem yet.
I'd argue that yes. This low ROIC likely reflects that aggressive growth reinvestment and the capital expenditure needed to build the foundation. It's not necessarily a sign of poor long-term capital allocation. As those high-margin segments, especially the technology platform, continue to scale up, we should expect that ROIC number to start climbing significantly.
Makes sense. Building the factory before you optimize a production line.
Okay, before we dive into the actual financial scorecard, let's pause for a quick moment. Just a reminder, don't forget to like and subscribe to Stock Analytics AI. For just €4.99 a month, you get access to our full playlist that's 500 deep dive videos covering all the S&P 500 stocks.
And coming up next, exclusively for our members, we're tackling the NASDAQ 100.
Plus, members can request specific stock deep dives. Just drop the ticker symbol in the comments and we'll get on it for you. Okay, let's put those strategic decisions and that management track record up against the actual numbers. Chapter 3, Financial Analysis.
Right.
The revenue growth, I mean, it's just undeniable. You look back at 2020, they did about, $565 million?
Around that, yeah. And now, trailing 12 months as of Q2 2025, we're looking at over $3 billion. That's an explosive trajectory.
It absolutely is. But as impressive as that top-line growth is, the real story, the narrative of the bulls have been waiting for, is that inflection point in profitability.
Talk us through that.
Okay, so gross margin has always been pretty strong, expanding nicely up to 82.2% in the latest quarter. But the operating margin turnaround is huge. It went from a massive negative 58% loss back in 2020 to a positive 10.4% on a trailing 12-month basis now.
Wow.
And critically, the net profit margin is now a solid 18.5% TTM. This clearly shows operating leverage kicking in. The revenue is just growing much faster than the costs needed to support it, and the milestone everyone points to. SoFi has delivered 7 consecutive quarters of positive GAAP net income profitability.
Hey, 7 quarters. That feels like a trend, not a blip.
Yeah.
Now, one metric that sometimes trips people up when looking at banks or financial institutions is free cash flow. SoFi's FCF is often negative. If they're profitable now, why is the free cash flow negative? Should you be worried about that cash burn?
Yeah, it's a great point, and it's where analyzing a bank is really different from analyzing, say, a software company. For a financial institution that's deliberately trying to grow its loan book very quickly, negative FCF can actually be a sign of strategic success.
How so?
Think of the loans they make, personal loans, student loans, as their inventory. The cash they spend to create or originate a new loan, which is their primary revenue-generating asset, gets counted as a cash outflow in the FCF calculation.
Ah, okay.
So in this specific context, negative FCF often indicates strong, intentional, aggressive growth in their loan portfolio, which is exactly what a growth company like SoFi wants to be doing right now.
Got it. So it's cash going out to build income-producing assets. That clarifies the inventory analogy perfectly. And what about their overall financial stability, leverage? How do they compare to traditional banks?
They look very conservative right now, actually. Traditional banks typically operate with pretty high leverage, using debt to magnify returns. But SoFi's debt-to-equity ratio is remarkably low, just 0.59.
Really low for a bank.
Extremely low. That signals good stability today, but it's also, dry powder for the future. As their earnings base becomes larger and more predictable, they have this huge untapped capacity to take on more leverage safely. They could use more debt to fund even more loan growth, potentially boosting future earnings without having to issue more stock and dilute current shareholders.
Okay, so stability now, potential for leveraged growth later. But all this growth, this potential, it comes at a cost in the current market, right? They trade at a massive premium compared to peers like Ally Financial or Synchrony.
No question. SoFi's price-to-earnings ratio is hovering around 57 times earnings. Compare that to Ally, maybe around 39x, or Synchrony, which is way down at like 8x earnings. The market is definitely slapping a tech multiple on SoFi, and not just a bank multiple.
And that 57x PE, that's really the heart of the debate, isn't it?
It absolutely is. It reflects the market buying into that whole narrative that this isn't just a bank, it's a vertically integrated financial technology platform that just happens to have a bank charter. The market believes they'll grow into that valuation and grow into it quickly.
Right. So speaking of the market, how is Wall Street reacting to that premium valuation? What's the sentiment out there? Chapter 4, Market Sentiment.
The sentiment right now is very much a show-me story, I'd say. It's leading to a really divided consensus among analysts.
So not everyone's buying the hype. It sounds like analysts are pretty split on whether this valuation is justified.
They really are. If you look at the consensus rating, it comes out as a hold. Now, you do have about 28% with buy ratings, which is positive, but interestingly, a significant chunk, 21%, actually rate the stock as a sell.
Wow, 21% sell. That's quite bearish.
It is. That wide divergence really highlights the deep skepticism out there about the current valuation and the execution risks involved, especially when you compare it to where the stock is actually trading.
And those analyst price targets, they tell a similar story of caution, don't they?
They do. The average 12-month price target from the analysts covering SoFi generally falls somewhere between $21 and $23 per share.
Which is significantly below the current price.
Exactly. It's below the current share price of 26.895 cents. That gap clearly signals a widespread belief among analysts that the stock price might be, running a bit ahead of its near-term fundamental value.
But the stock itself isn't listening to the analysts.
Not really, no. The technical picture tells a very different story right now. The stock is in a clear, strong, long-term uptrend. The price is trading above its 50-day moving average, which is around $25.80, and it's significantly above the longer-term 200-day moving average, down near $17.70. So the market momentum is currently defying those cautious analyst targets.
Interesting disconnect. What about short sellers? Are people betting against the stock?
There is meaningful short interest, yes. It stands at about 8.78% of the float. That's not insignificant, definitely indicates some bearish bets out there. But the potentially positive sign for bulls is that the trend in short interest has been downward recently. That suggests at least some short sellers might be covering their positions, perhaps spooked by that strong technical momentum.
Okay, let's shift gears then and look at who actually owns the stock. Chapter 5, Ownership Structure.
Right.
The institutional presence looks pretty solid. Big passive index funds like Vanguard and BlackRock are major holders, right? Institutions own a majority of the shares.
Yeah, institutional ownership is quite robust, somewhere between 53% and 59% of the outstanding shares. And yes, the giants are there. Vanguard holds about 9.1%, BlackRock around 4.1%.
And is money flowing in or out from those big players?
The flow seems to be net positive recently. We saw data showing around 440 institutions actually increase their positions in the last reporting period compared to those reducing. That kind of quiet accumulation often acts as a durable vote of confidence in the long-term story,
Hmm.
probably driven by factors like that bank charter we discuss.
Okay, so the big money seems generally supportive. What about the insiders? Are management's interests aligned with shareholders?
It looks like it, yes. Management and insiders collectively own a substantial amount of stock, reportedly over $500 million worth, and CEO Noto himself holds about 0.8% of the company, which is significant.
So they have skin in the game. Any recent buying or selling from them?
This is a point worth noting. Their interests seem aligned based on holdings, but recent activity requires a bit of monitoring. In the last 3 months, we've seen 13 insiders executing scheduled sell transactions. These are usually pre-planned automatic sales, often linked to tax obligations or financial planning.
Okay, so not necessarily a red flag on its own.
Not necessarily, no. However, during that same period, there were zero open market purchases by insiders. So while the selling might be routine, the complete lack of any insiders choosing to buy shares at these price levels is a data point investors might want to keep an eye on, especially if the stock price stays this elevated.
Okay, now for the really interesting part, I think. The risks. What could go wrong? What potentially keeps the CEO up at night? And what should investors be most concerned about? Chapter 6, Risk Assessment.
Yeah, this is crucial because the whole investment case for SoFi really hinges on near flawless execution going forward. We can use the SWOT framework strengths, weaknesses, opportunities, threats to kind of structure the key challenges.
Okay, let's focus on the potential downsides first. What are the main internal weaknesses or external threats?
All right, starting with an internal weakness. The biggest one is probably the concentration in personal loans. Despite their diversification efforts, their loan portfolio is still quite heavily weighted towards unsecured personal loans.
And those are inherently riskier than, say, mortgages.
Generally, yes. They aren't backed by specific collateral like a house or a car. So if a borrower defaults, the recovery rates are typically lower.
And that weakness links directly to what many see as the biggest external threat, right? A potential macroeconomic downturn.
Absolutely. That's the elephant in the room. This loan portfolio, especially at its current massive scale and with that personal loan concentration, it really hasn't been stress tested by a severe prolonged recession. The kind where unemployment spikes significantly.
What happens then?
If we see widespread job losses, particularly among SoFi's target demographic, which tends to be higher earning professionals, but still vulnerable, you could potentially see a sharp, maybe unexpected jump in default rates across that personal loan book. That's arguably the single biggest credit risk facing the company.
Okay, credit risk is number one. What else? Regulation.
Regulation is a huge one coming up. They're basically becoming a victim of their own success here. As of Q2 2025, their assets hit $41 billion. They are rapidly approaching that critical $50 billion asset threshold.
And why is $50 billion so important?
Crossing $50 billion automatically subjects a financial institution to much stricter rules-enhanced prudential standards, tougher capital requirements, more intense regulatory scrutiny. They'll be regulated much more like the big established banks. It requires a whole different level of compliance, risk management, and capital planning.
So growing pains, but on a regulatory level.
Yeah, exactly. And it's not just size. There's also increasing regulatory focus globally on the use of artificial intelligence in lending decisions, which is relevant given SoFi's emphasis on its proprietary tech stack for underwriting. That's another potential regulatory hurdle.
Okay, so credit risk, regulatory hurdles. We keep coming back to it, but that valuation itself feels like a risk.
Definitely. It has to be listed as a key weakness or risk factor. That 57 times PE ratio leaves practically zero room for error. If SoFi stumbles, if growth slows unexpectedly, if credit losses tick up more than forecast for even a quarter or two, that stock multiple is highly vulnerable to a significant, perhaps rapid compression.
So the pressure to execute perfectly is immense.
Immense. But just to keep the analysis balanced, we have to remember those powerful strengths acting as defenses we talked about earlier. That national bank charter provides a huge cost advantage, and that integrated tech stack with Galileo and Technisys gives them agility and control. Those are their key weapons against these risks, and the intense competition.
Okay, that synthesis brings us perfectly to our final chapter. Let's pull it all together. Chapter 7, Conclusion.
Right, let's try to synthesize the bull versus the bear case here.
Go for it. Bull case first.
The bull thesis really rests on a few key pillars. You've got a proven world-class CEO in Anthony Noto. You have that proprietary tech stack creating a real competitive moat. They're tapping into a massive addressable market for financial services. And crucially, that bank charter provides a powerful, cost-advantaged growth engine. The growth is undeniably real, and the operating leverage is now proven with those 7 quarters of profit.
Okay, sounds compelling. Now, the bear case.
The bear case basically hammers on 3 points. First, that premium valuation we just discussed, it demands perfection. Second, the unproven resilience of that concentrated loan book if we hit a really nasty recession. And third, those looming regulatory hurdles as they cross the $50 billion asset mark and face much stricter oversight.
Execution risk, credit risk, regulatory risk, all amplified by a high starting price.
That sums it up well. Now, we promised a valuation summary based on our educational discounted cash flow model, and this involves making assumptions about future growth, margins, discount rates, etc. We estimate the intrinsic value range for SoFi Technologies to be somewhere between $18.50 and $25 per share.
Okay, $18.50 to $25. And the stock is currently trading
At 26.895 cents, so the current market price is sitting slightly above the high end of our estimated intrinsic value range.
What does that tell you?
It tells us the market is very confidently pricing in not just continued high growth, but also the successful navigation of all those future challenges, especially the regulatory ones. If you're investing today at this price, you really need to be comfortable weighing that undeniable long-term potential against the very real valuation risk and the credit cycle risk. The margin for safety looks thin right now based on these numbers.
Makes sense.
Yeah.
High potential, but high expectations already baked in.
Exactly. And maybe here's a final provocative thought for you, the listener, to mull over. Given how fast SoFi is growing its assets, perhaps the biggest medium-term risk isn't actually a recession next year. Perhaps it's more about how effectively management can transition the entire company's culture and operations to function under those much stricter capital and liquidity rules once they inevitably cross the $50 billion, and then later the $100 billion regulatory thresholds. That's a huge operational and cultural shift for a fast-moving tech company.
That's a great point to end on. Thank you for joining us for this deep dive into SoFi Technologies.
And remember to like and subscribe to Stock Analytics AI. Don't forget to drop a ticker symbol in the comments if there's a stock you want us to cover next.
Absolutely.
And finally, our standard AI research disclaimer. Please remember, this analysis was generated by an AI system. It's intended for educational purposes only and should definitely not be taken as financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.